Sonal, Varma joining us this morning, Managing Director and Chief Economist, India and Asia, ex-Japan at Nomura from Singapore. Sonal, always a pleasure to speak with you. Let's talk tariffs and where it goes from here in your view for India. Do you expect that there will be a better rate than 25 plus unnamed penalties coming in for India and US?
I mean, as you said, I think uncertainty is extremely high. The 25% reciprocal tariff, we do think negotiations still continue. And as we know that in end August, the US trade team is visiting India. The Indian side will be open to some concessions, and a lot of our competitor nations have actually got a tariff rate of 19 to 20%. So we do think this is a temporary high tariff rate, which will settle down lower, in the next maybe 2 to 3 months once things are ironed out. But there are other things to keep in mind. I think the immediate focus is clearly the penalty on Russian oil imports. That could be something more important in terms of impact in the short term. And beyond that, we are still awaiting tariffs on sectors like pharmaceuticals and semiconductor electronics more broadly. These sectors are roughly about a quarter of our exports to the US and are currently unimpacted actually by the 25% reciprocal tariff. So these are still things to monitor. So it's going to be a bit of up and down going forward on the tariff front.
Hi, Sonal. Morning, Alex here. I'm just wondering about how you're gauging GDP growth then, because at 25% tariffs, you would talk about an implication of what people are saying, 20 basis points. I wonder what you think. But then if that is reversed, then there is still an increase in the tariffs. There would be some impact. So how do you, does that change your projections for the year? And how much are you building in this policy, this week's monetary policy, in terms of rate cuts, or do you expect a pause?
Yeah, on RBI, we are expecting a pause this week, but we do have more easing coming through in October and December. So we think the terminal rates will end up being 5%, which is lower than current consensus estimates of maybe either no cuts or just another 25 cut. On the tariff rate, as I said, pharma, electronics, these are exempt. So the effective tariff rate on India is, on our estimates, lower than the 25%, but still significantly higher than what we had previously assumed, which is around 10%. And based on the impact on exports and elasticity of demand for exporting sectors, we see a downside risk of 20 basis points to our baseline GDP growth projection of 6.2%. Now, the sectors that are more exposed to the current tariffs are the ones that are more labor-intensive and low-margin sectors. So textiles, gem and jewelry, leather, the margin pressure for these sectors could be significant. There could be an impact on jobs. So this will require more support, targeted support measures actually coming through from the government for these specific export sectors. But the other thing I do want to flag is, if you look at the modified reciprocal tariffs that were announced on Friday for all countries, most countries that India competes with have got a tariff rate of either 19% or 20%. Only Japan and Korea and EU are at 15%. So if it looks like, based on the tariffs given to other countries, that the 25% could get negotiated down, but it will still be a 19 to 20%, which is not different to our competition and means that the near-term benefit we were hoping for from trade diversion opportunities, that is unlikely to come through. And just one final point, as with these episodes, it's really the indirect effects that are harder to monitor in terms of and quantify in terms of the impact on investment, etc. So that's something to keep an eye on as well going forward.
Sonal, good morning. Moving picture. So, do you think that for the sectors which are impacted, you said some of the smaller sectors, and they might need some fist support, can the government do that without having to bat too many eyelids on what the actual fist situation of India might be for FY26? Could that happen?
Yeah, I think so. I think what we are looking at right now is sort of more targeted support for exporters in specific product categories. This could take the form of, an interest rate subvention or some sort of a duty drawback scheme while complying with the WTO norms, or let's say a government guaranteed loan from banks to give like a 6-12 month working capital loan to these targeted sectors, so that they can tide over any cash flow constraint they may face because of this tariff hit. Typically, the fiscal cost of these interest rate subvention measures is sort of shared between the government and banks, and the fiscal hit to the government per se should be, I think, manageable in the overall scheme of things. The bigger risk for fiscal will be if we see a significant growth slowdown, which hurts tax revenues, because during that period, the government would also want to front load its own capex to offset weak private demand. So at this stage, we don't think fiscal is a risk, even if these targeted measures are announced. It would become a risk if we see a more material growth slowdown.
And Sonal, just wondering, is that a clear and present danger, a real growth slowdown, or you think, I mean, most notes speak 2%, 2.5% of GDP impacts of the overall export pie, not that dramatic, so on and so forth, and therefore let's not raise alarm bells around this. Do you concur?
At this stage, I think that's a fair assumption, because the domestic side, things are soft. I think both on private consumption as well as on private investment. But the economy is still in the 6-ish kind of real GDP growth handle. We are not seeing a material deceleration. It could become a risk if, what we've seen with the US with the jobs data, if it is not a one-off shock and indeed suggests that the US is slowing more than expected, then the global ramifications from a weaker US economy would also have some spillover to India. And I think the government, given all the uncertainty that is there on the trade front, I think the fiscal side, they would want to basically ensure things are certain, that the government is committed to fiscal consolidation while supporting growth. So I do concur with that baseline. Obviously, there are downside risks to growth both in India as well as globally, and that could unravel the fiscal situation. But that is not the scenario we're looking at right now.
Sonal, quick question on the shocker of jobs data. And of course, the interesting reaction to it, I don't know if you want to respond to that, but the interesting reaction where the guy who puts the data together gets fired because the president doesn't like the data. But are we seeing some pain coming in as an impact of tariffs now in the US economy, which so far wasn't this apparent?
I mean, it's definitely much worse than expected. And I think the downward revisions, the fact that the private sector job creation is slowing, some of the cyclical sectors like manufacturing continue to contract jobs, is suggesting that the job market in US is not only cooling, but it is cooling more rapidly than one had thought. Now, the tricky part is with respect to whether this is going to lead to something that is a more material deceleration in the labor market. And one of the challenges right now is that because of slowing immigration growth, there is an impact on the NFP readings. And therefore, one needs to look at the broader set of labor market indicators, including the unemployment rate, jobless claims, what's the firing rate, etc., to assess what the true conditions are. And NFP and all details were very weak. The other broader labor market indicators are not suggesting as steep of a slowdown as NFP was suggesting. So this does put the Fed in a very tricky spot, because we're now entering a period where we actually think the tariff-induced goods price increase will be visible. But there's also this risk on the labor market. So that does put them in a tight spot. Our view is right now the Fed is going to prioritize inflation. So despite the weak jobs market, we don't think the FOMC more broadly is convinced that a rate cut is imminently needed.
Thank you so much for that, Sonal Varma there from Nomura, saying that maybe slowing down of immigration could have also had an impact on non-farm payroll data. I thought that was interesting.